Hello everyone, welcome to our channel. This is Dr. Murlidhar. In this video, I am going to explain you one of the important topics in security analysis and portfolio management, that is capital asset pricing model. What exactly this model refers and describes? Basically, this is describes the relationship between expected return and risk of investing in a security. Normally, this is the extension of the short single index model approach. There itself, the single index market index has been taken into consideration for the risk return trade off. Whereas capital asset pricing model is construction of the portfolio. The expected return on a security is equal to the risk-free return plus risk premium. What do you mean by the risk premium? How much investor is expecting additional to the risk-free return is known as the risk premium. This is totally based on the beta sensitivity of volatility of the market. It calculates the systematic risk of the concerned security. So I have given one small concept about the capital asset pricing model. Here, this is the risk-free rate. Basically, this risk-free rate is anyone is taking on the basis of their country or company the government security bond. Means if you invest in this security, you are not going to have any risk. You are going to get fixed return on that investment. No need to bear any risk on that. That is called risk free rate of return. So this is the market return. See, the mean this the orange spot is the risk premium. If you take risk free rate is a 3%, market rate is 9%, the risk premium is between this 3% and 9%. That is called risk premium. See, the beta, the risk market. How much risk according to the market is known as the beta, the sensitivity of the market. This is what exactly the capital asset pricing model describes. Right. Again, I'm going to tell you risk-free rate of return and risk premium and beta. These three characteristics to identify the expected return on investment. So the capital asset pricing model clearly states that what is the expected rate of return on investment by taking into the consideration of risk-free rate, beta of the investment, and expected market return on the investment means market risk premium too. These are the basically the capital asset pricing model describes, right? Essentially, the capital asset pricing model developed by William Sharp. As usual, the Sharp single index model is also described and developed by the William Sharp. This is the an exercise in positive economics. See, basically this is concerned with two key questions. What is the relation between risk and return of total efficient portfolio? And what is the relationship between risk and return for an individual security? Right. So the risk return trade off, the relationship between risk and return for total portfolio, that should be efficient, and the relationship between risk and return for an individual security. Having said that, how to calculate? See here, the expected return on investment by calculating this is first they are going to take into consideration of risk free rate, any investment or rate of return we are getting on the government bonds, that is called risk free rate. You can take any for that matter, right? Beta of the investment and expected return, market return on the investment, and market risk premium, right? Now, having said that, I will go by one about all these things. The formula, what is expected return? It is represents the expected return of a capital asset over a time, given all other variables in this equation. So it is a long-term assumption that how an investment will play out over its entire life. Again, what is risk-free rate? As I mentioned earlier, this is you can take 10-year US government bond or treasury bond. So the government yield typically they are going to take, because they are not going to bear any risk when you are investing in the government bonds. The risk-free rate should correspond to the country where the investment being made, and the maturity of the bond should match the time horizon of the investment. Having said that, let me go for important concept, that is a beta. So it's a stocks risk volatility of returns, because every time the market is fluctuating over a period of time, it is reflected by the fluctuation of its price changes relative to the overall market. Again, it is a stock sensitive to the market. For instance, if company's beta is equal to the 1.5, the security has 150% of the volatility of the market average. However, if the beta is equal to 1, the expected return on a security is equal to the average market return. If beta is minus 1 means security has a perfect negative correlation with the market. Then market risk premium. As I mentioned earlier, this is the risk premium expected return of market minus risk-free rate. So always expected return of the market is more than the risk-free rate, because the investor, any rational investor is going to expect more return than the risk-free rate of return. So the market risk premium represents the additional return over and above the risk-free rate, which is required to compensate investors for investing in riskier asset class. So in another way, more volatile market or an asset class is higher the market risk premium will be. Then what are the assumptions while identify the expected rate of return in the capital asset pricing model? Right. The first one is individuals are risk averse. All the investor who are investing as per the CAPM model, they are not going to take any risk. They are the opposite to the risk. They are not going to take more risk. They want more return, but they wanted to take less risk. They are the risk averse. Another point I would like to mention over here is individuals seek to maximize the expected utility of their portfolio over a single period of planning horizon. Again, individuals have homogeneous expectations. They have identical subject to estimates of the mean, variance, and covariance among the returns. Again, whenever they wanted to money, they can borrow. Whenever they wanted to give freely at riskless rate of interest. The market is perfect. There are no transaction costs, no taxes. Securities are completely divisible. The market is perfectly competitive. The other one, the quantity of risk securities in the market has to be given. These are the basic assumptions of capital asset pricing model approach. Then, what are the advantages? What are the disadvantages? Right? See, the CAPM model is widely used in the all the finance industries. It is a vital in calculating weighted average cost of capital. What do you mean by cost of capital? The cost of capital is minimum expected rate of return by the investor from his investment is known as cost of capital. See, this model is vital in calculating the weighted average cost of capital. So, as CAPM computes cost of equity, WACC, weighted average cost of capital, is used extensively in financial modeling. The other one is easy to use. Consider systematic risk, establishes theoretical relation between risk and return trade-off, vital in weighted average cost of capital calculation. Superior discount rate in investment proposal means it can be used to find the net present value of the future cash flows of an investment, and to further calculate its enterprise value and finally its equity value as well. The when I talk about the disadvantages, basically the assumption of risk-free rate is unrealistic. So normally any rate of return there will be some type of risk. Even if it is a government bonds, inflation risk is there, right? That is a unrealistic approach by the CAPM. Second one is substitute of risk-free rate yield on government bonds keeps fluctuating. Even government of India bonds also there are keeps on fluctuating. The third one is betas. The systematic risk measurement don't remain stable over a period of time. It will be fluctuated. The rate of return based only on one factor, that is a systematic risk. Then focuses only on single period time horizon. All these are the different disadvantages as far as the CAPM is concerned. Then the conclusion part of the capital asset pricing model is the fundamental tool in finance used to determine the expected rate of return of an asset based on its systematic risk. The systematic risk is nothing but a undiversifiable risk. The risk which we can't diversify, such as market risk, inflation risk, interest rate risk, we can't diversify on any other companies or other company securities. By incorporating risk-free rate of return, market return, and beta, the model provides simple and effective way to estimate an asset's required return, helping investor to make decision making about portfolio diversification and risk assessment. Despite its widespread use, the CAPM has several limitations. It assumes the perfectly efficient market, which is basically unrealistic and not possible at all, and relies on historical beta values, which may not always predict future risk accurately. Additionally, factors like investor behavior and market anomalies are not accounted for in this model. However, this remains valuable framework for understanding the relation between risk and return. While alternative models such as arbitrage pricing theory and FAMF French models have emerged, CAPM continues to be cornerstone in modern financial analysis due to its simplicity and practical applicability. This is as far as the conclusion part of the capital asset pricing model approach. And the last one, though it is having the drawbacks, it provides useful foundation for evaluating investment risk and expected returns. Investors should always complement it with other models, qualitative judgment, and to make well-rounded investment decisions while investing their portfolio. This is what exactly about a CAPM model. Thank you. Thank you for watching. Thank you for staying with me. Thank you for your support and encouragement. Thank you, one and all.